RSM Financial Services. We're lucky enough to have Bill Keenan here from Lonsec. He's just going to talk about a couple of the stocks and changes you've made to the core portfolio. Thanks. Bill, in your core portfolio, Brambles is an interesting stock. It's come off somewhat in the medium term, so what are your thoughts there?
Yeah, Brambles has been affected by a bit of a slowdown in the US, which was a bit of a surprise to us. There's also management transition going on at the moment, CEOs transitioning. The stock's a quality stock, it's got a very strong position globally in Europe, in the US, and in Asia. And there's nothing really wrong with the stock in terms of its positioning in other countries and its balance sheet, it's all still strong.
Yep.
So really they've just got to sort out the US situation. The stock has come down a fair way, over 20% in the last few months, and I think it's basically too cheap now. It's trading on about 8.5 times EBITDA, which is pretty cheap for a global leader like Brambles.
Okay.
Our fair value is around $10.33. We think it will come back up to the $10 level. We'll probably reduce the weight a little bit from 7.5% to 5%, but likely to hold it from there. We've done a lot of work on the new CEO. We think he's the real deal.
Yep.
And we're looking for the next sort of update from the CEO in terms of corporate strategy, in terms of the outlook, to get a bit more confidence around the stock. But we do think it's a situation where there is a good opportunity here to pick up a quality stock at a reasonable price.
Okay. Telstra is another topical stock that you've recently removed from the core portfolio, Bill. What are your thoughts behind that?
Yeah, Telstra, unfortunately, despite the strong yield, the core earnings are in decline, and at the moment the NBN payments it's receiving from the government are propping up the earnings and keeping them flat. But by 2022, those NBN payments cease, and the company's EBITDA, which is around $10 billion, will fall by around $2 to $3 billion. So it's a fair gap, and Telstra's basically got 5 to 6 years to fill that gap. So the message is they're running flat out, just trying to keep their earnings flat. So it's not the ideal growth stock, and certainly we took it out of the growth portfolio. In terms of the income portfolio, we are also thinking about taking it out there. The income is very good, no doubt, but without a growth rate, the valuation is really hurt, and you find that our valuation falls to around $4.33, and indeed after it went ex-dividend, it does seem to be drifting down to that level. It'll probably hold at that level, but yeah, its capital growth is at risk at the moment, and competition is likely to increase because the competitors, in terms of Optus, TPG and Focus, have now all consolidated the market, and they're all looking to, I guess, compete a bit more for the mobile territory and the cable territory, and it's hard for Telstra to increase its prices from here. So we're a bit wary on the Telstra story. In fact, the whole telco sector is looking very competitive, and we don't have any exposure to telcos anymore.
No, great, Bill. Thanks for those comments.